A 50-cent AI stock and a $2 AI stock, both connected to the same industry creating trillion-dollar companies. That doesn't make sense, and that's exactly the point. While everyone is watching AI giants, some of the infrastructure behind them is still trading at extremely low valuations. So the real question is, are these overlooked or just ignored for a reason? Let's find out. AI is rapidly becoming a global infrastructure build-out. We're seeing expansion across data centers, automation systems, and defense analytics, and also across enterprise software platforms. But here's the part most people miss. Investor attention is heavily concentrated on companies building large AI models, and also on those developing advanced chips. Meanwhile, companies operating inside compute layers and data processing systems often receive far less attention. And those in enterprise AI platforms also receive far less attention. This is where pricing inefficiencies usually exist. Historically, this is the type of layer institutions quietly watch before broader market awareness shows up. Now, this doesn't guarantee anything, but it explains why certain small-cap companies inside the AI ecosystem can become relevant later. And this is exactly where smaller-cap opportunities tend to form. Think about what powers AI systems behind the scenes. Not the models, but the compute infrastructure required to run them. Massive data processing, continuous computation, high-performance hardware. But here's the catch. AI systems don't just rely on software, they depend on physical computing power. And building that infrastructure requires specialized hardware designed for processing large datasets efficiently. Now this is where things get interesting. One small company has built technology connected to high-performance computing environments that support data-heavy workloads. And later, we'll look at another company focused on a completely different layer. AI-powered content intelligence. AI workloads continue increasing across industries. From blockchain systems to machine learning environments, processing large volumes of data requires scalable computing infrastructure. If AI adoption continues expanding, demand for compute and processing capabilities naturally increases. And if this layer expands, companies operating inside it become increasingly important. This stock has seen major volatility. At earlier points, shares traded significantly higher during strong interest in compute-related technologies. Then, the stock pulled back as market sentiment shifted and small-cap tech cooled. Today, it trades around $0.56 per share. So now the question becomes, if demand for compute infrastructure continues growing, could companies like this regain attention? The company focuses on hardware systems designed for high-performance computing and data processing environments. Its technology is used in systems that require continuous computational workloads, connecting it to broader trends in data processing and AI infrastructure. And this is where things shift, because when you actually look at the company behind this infrastructure layer, you find Canaan Inc., ticker CAN, currently trading around $0.56 per share. Now, obviously, this doesn't mean the stock moves tomorrow. Hardware markets can be volatile, and smaller companies face real scaling challenges. There are risks here. But the reason it remains at a low valuation may simply be that the broader market is focused on larger AI hardware players, and timing, as always, is the key factor. Now, before we get into the second stock, here's something most people completely overlook. Even though AI demand is exploding, many companies operating inside infrastructure layers still see delayed market reactions. And historically, those delayed reactions are exactly where smaller cap opportunities sometimes appear. But unlike the first company, which operates in hardware and compute infrastructure, this second company focuses on something very different: AI-powered content and data intelligence. Where the first processes data, this one helps organizations understand it. And this is where things get interesting. Organizations today deal with massive amounts of digital content, audio, video, text, and unstructured data. AI platforms can now analyze that content to extract insights, detect patterns, and automate decision-making. That's exactly the type of system this company builds. AI software designed to help businesses process and understand complex datasets. If AI adoption continues expanding across media, enterprise software, and data analytics, platforms that can analyze and organize large datasets become increasingly valuable. Because AI isn't just about generating content, it's about understanding information at scale. This stock has also seen volatility. At earlier stages, shares traded significantly higher during strong interest in AI-driven software platforms. Then, the stock pulled back as market sentiment shifted. Today, it trades around $2.27 per share. So again, the question becomes, if AI continues expanding across enterprise software, could this platform regain attention? And this is where it gets interesting. Because the company behind this AI platform is Veritone Inc., ticker VERY, currently trading around $2.27 per share. Again, this doesn't guarantee anything. Enterprise AI platforms are competitive, and smaller companies face real challenges scaling their solutions. There are risks here, but the gap between AI adoption and market attention may explain why companies like this remain relatively overlooked. So now we have two very different AI infrastructure plays. One focuses on hardware and compute power. The other focuses on software and data intelligence. The first benefits if demand for AI processing power increases. The second benefits if demand for AI-driven data analysis expands. So the key question becomes, which layer scales faster? Compute infrastructure powering AI systems or software platforms interpreting data? That tension is exactly what makes early-stage AI investing complex. Stepping back, both companies operate in layers of the AI ecosystem that don't always get immediate attention. Not the models, not the headlines, but the infrastructure supporting them. Historically, these layers tend to move later, but when they do, they can move more aggressively as the market begins pricing in their role. And this is exactly the type of layer institutions quietly watch. If you want to keep discovering smaller AI infrastructure companies before they reach broader attention, stay tuned for future breakdowns. Because sometimes the biggest opportunities exist in the layers most investors overlook first.